Hi everyone, welcome to the market weekly wrap up today. And I will take you all with the key market events and the key things that really happened in the market this week. Starting with the most important thing that really triggered the market was the monetary policy meet that came in this week, and the monetary policy hiked the policy repo rate by 50 basis point. So this move is pretty much in tandem with what is happening globally with the global counterparts. US, UK, Canada, Mexico are among the other countries are hiking the interest rate cycle. More than 50 central banks globally have hiked at least 50 basis point as on today. So RBI, being the central bank, today as on today has hiked closer to a percent, right? 40 basis point was hiked in May, and 50 basis point is hiked in June, which was just this week. So this hike is pretty much aligning with the evolving global macro conditions, the shocks from the commodity prices that we are seeing, supply disruptions globally, and the upward inflation trajectory that we are seeing, globally in the markets. The key macro data points are that the repo rate stands at 4.9, the standing deposit facility stands at 4.65, MSFF bank rate stands at 5.15, the cash reserve ratio stands at 4.5. The real GDP forecast for FY23 is maintained at 7.2%. The CPI number has been revised and it's on an upward scale compared to the last projection. So right now it stands at 6.7 for FY23 compared to the last time it was at 5.7. So the reason why this rate hike has happened and the rationale for the rate hike is, most importantly, the Russia and Ukraine crisis have led to the global crude oil prices, going way above the long-term averages. And back in India, we see, crude oil prices affecting fuel prices as well. So crude oil prices have been going above $100 per barrel, which is all-time highs. Inflation in US stands at 8.3%, which is also an all-time high, a four-decadal high. The hike in input costs have seen the margins, of the balance sheets and of the corporate squeezed off. So this hike in input cost is coming in because of the supply chain issues, the supply chain bottlenecks. For example, in the auto sector, we are seeing, the chip shortages that are coming in, and because of which the sales of the auto sector is getting affected. Uh, Along with that, the high inflation really erodes the purchasing power of the households. China again is seeing lockdowns coming in, and because of which the emergence of COVID infections have come in China. So these are the key triggers why RBI is going on a tightening of monetary cycle. Previously in the pandemic era, we were in a loose monetary zone, right? And now we are seeing an upward trajectory of the monetary policy getting tightening, and all the liquidity is getting sucked out from the system. For the equity markets, the week was pretty volatile because all the major indices were down for the week. The main trigger being the RBI and the inflation numbers that really came in. We maintain our, outlook on companies that are really placed to benefit in the interest rate cycle. These are the companies that have good quality management, they have good amount of cash flows, good liquidity in the system, and some sectors like banks will be really placed to benefit from the interest rate hike cycle. Back over here in domestic economy, the country will really recoup because it has good amount of exports, GST collections, PMI numbers, forex reserves, and the economy will recoup overall. We expect the RBI to pretty much manage the yield curve for the country, and the 10-year GSEC is expected to be in the range of 7.35 to 7.65, and we recommend investing in instruments that have a medium term horizon of 3 to 4 years. So thank you so much, and have a great day.